The biggest fortunes in history did not shrink over years. They vanished before breakfast. A bank whose offices ran from Wall Street to Tokyo went dark in a single weekend. A flower bulb worth a canal house was worth nothing within weeks. One man ran his firm for decades. It ended with one phone call to his own sons. Lehman's last weekend. It was the fourth largest investment bank in America, with offices from Wall Street to Tokyo. By Monday morning, it did not exist. Lehman Brothers had spent years borrowing far more than it held, a habit known as leverage, meaning a firm bets with more money than it actually owns. Mortgage bonds that once looked safe turned worthless one after another, and the losses stacked up faster than the bank could absorb them. Regulators spent a September weekend in 2008 searching for a buyer. Barclays wanted the trading business but not the risk, and without a government guarantee, no deal closed. Richard Fuld, the bank's chief executive, had built a firm worth roughly $60 billion on paper, about the value of every home in a mid-sized American city. On September 15, 2008, Lehman filed the largest bankruptcy in American history. Employees carried their belongings out past television cameras within hours of the filing. The failure pushed Washington to write new limits on how much borrowed money a bank could risk, limits that still shape banking today. A single unanswered phone call rewrote the rulebook for an entire industry. A company with no ships. The certificate promised a monopoly on trade with an empire that barely existed. In London in 1720, the South Sea Company held the exclusive right to trade with Spanish America, a right worth far less than investors assumed. Company directors spread word of fortunes waiting in South American gold, so shares climbed from £100 to nearly 1,000 within months, pulled up by nothing but expectation. Isaac Newton, already famous for describing how planets moved, bought in early, sold at a profit, then watched the price keep climbing and bought back in near the top. When the company's actual trade revenue arrived and proved almost nothing, the shares collapsed within weeks. Newton lost roughly £20,000, a sum worth several $1,000,000 today, and reportedly banned anyone from mentioning the company's name in his presence for the rest of his life. Parliament investigated afterward and found company officials had bribed ministers to inflate the scheme's credibility. Several were expelled from office and stripped of their gains. The most brilliant mind in England had correctly calculated the orbits of comets. He could not calculate a crowd. A house for a flower. Every merchant in Amsterdam knew a single tulip bulb could be traded for a canal house. Through the 1630s, the Dutch Republic had built enormous trading wealth, and buyers began treating rare tulip bulbs as investments, trading paper contracts, agreements to buy a bulb later at a fixed price, months before the flower even bloomed. A Haarlem cloth merchant reportedly traded an entire year's income for a single Semper Augustus bulb, prized for its flame-streaked petals. In February 1637, buyers at a routine bulb auction simply stopped bidding. No new law forced the change, no war, no crop failure, only a quiet loss of confidence that spread from one auction room to the next within days. Contracts that had promised fortunes became unenforceable paper, since courts refused to make buyers pay for flowers that had lost their value overnight. The merchant who once held a house-sized fortune in a flower pot held a wilted bulb and a debt he could not collect. When furious buyers dragged their contracts before Dutch magistrates, the courts found nothing to enforce. A promise to pay a fortune for a flower was worth exactly what the flower was, and the flower was gone. The Match King's Empire. Ivar Kruger arrived in the 1920s with a simple idea: lend money to entire nations in exchange for a monopoly on matches. By the end of the decade, his company controlled roughly 3/4 of the world's match production, and governments from France to Poland depended on his loans to balance their budgets. Kruger ran his empire through a maze of holding companies, businesses that exist mainly to own shares in other businesses, which let him hide debts in one corner while showing profits in another. Auditors rarely saw the whole structure, only the piece he chose to show them. His personal fortune was estimated at the time in the hundreds of millions of dollars, worth 75 to 100 billion in today's money. In March 1932, with creditors demanding real numbers, Kruger shot himself in his Paris apartment. Investigators who opened his vaults afterward found the promised Italian government bonds backing much of his empire were forgeries, printed by Kruger himself. The Match King had lit his own fuse years earlier. Stockholm just hadn't heard it burning. The gold that wasn't there. In 1997, a small Canadian mining company claimed to have found one of the richest gold deposits ever discovered, buried in the jungle of Borneo. Bre-X Minerals had drilled core samples from its Busang site that showed extraordinary gold content, and the stock climbed until the company was valued at several $billion, a paper fortune bigger than the market value of most national airlines combined. Independent geologists eventually asked to test the same soil, and found almost no gold at all. The company's core samples, it turned out, had been salted, meaning outside gold dust was mixed into the samples before testing to fake the results. Michael de Guzman, the company's chief geologist, died in a fall from a helicopter over the Indonesian jungle while flying to meet independent auditors, a death officially ruled a suicide. Trading in Bre-X shares was halted, then resumed only long enough for the stock to fall to almost nothing in a single day. When outside engineers finally cracked open the drill logs themselves, the richest gold strike in a generation turned out to be dust filed from a handful of gold rings and mixed into empty rock. The sons who made the call. He ran the most trusted investment firm on Wall Street, one that turned away new clients to seem more exclusive. Bernard Madoff had promised steady returns for decades, using new investors' money to pay the older ones, so the returns looked genuine, which brought in more investors, which meant the hole underneath kept growing. His fund's paperwork, when finally examined, showed trades that never happened on markets they never touched. In December 2008, with withdrawal requests he could no longer cover, Madoff told his own sons the business was one giant lie. His sons reported him to federal authorities within a day. Investigators eventually tallied roughly $65 billion in claimed but non-existent gains, close to $90 billion in today's money. Thousands of retirees who trusted decades of steady statements learned their account balances had been fiction for years. A federal judge handed Madoff a sentence of 150 years behind bars in 2009. He died in prison in 2021. The man who spent a lifetime building trust destroyed it with a single confession, delivered to the two people who trusted him most. Rogue trader, empty vault. Nick Leeson worked a Singapore trading desk that head office in London barely understood, quietly hiding mounting losses in an error account meant for minor clerical mistakes. Barings Bank was Britain's oldest merchant bank, 233 years old, having once financed the Napoleonic Wars and the Louisiana Purchase. Leeson made unauthorized bets on Japan's stock market using derivatives, contracts whose value depends on the future price of something else. And when an earthquake hit Kobe in January 1995, the market moved against him hard. He kept doubling his positions to recover the losses, which only doubled the damage, until the hidden account held debts of roughly £827 million, more than the bank's entire capital, enough to have bought several jumbo jets outright. Leeson fled to Germany and was arrested at the airport. Barings collapsed within days and was sold to a Dutch bank for one symbolic pound. When administrators finally opened Leeson's private ledger, Britain's oldest bank turned out to have staked its entire capital on trades that head office in London had never approved and never even seen. The Nobel Prize that didn't help. The formula behind the fund had won its creators a Nobel Prize the year before. Long-term capital management launched in 1994, with 2 Nobel laureates and a strategy built on arbitrage, profiting from tiny temporary price differences between related securities that models said should not exist for long. The fund borrowed roughly $25 for every dollar of its own capital, so even small market moves produced enormous gains or losses. When Russia defaulted on its debt in August 1998, markets moved in ways the models had called nearly impossible, and the fund's positions collapsed together instead of balancing each other out. Within weeks, a fund holding over $100 billion in positions had lost roughly $4.6 billion of its own capital, close to $8 billion today. Fearing the fund's collapse could freeze markets worldwide, the Federal Reserve organized a rescue among 14 banks who bought out the fund to unwind it slowly. The formula had correctly priced risk for 4 years. It had never priced the year everyone panicked at once. The retirement that vanished. She had worked at the company for over 2 decades, watching her retirement account grow entirely in company stock, the same stock her employer encouraged her to hold. Enron had built a reputation as one of America's most innovative energy companies, partly through an accounting method that let it book expected future profits as current earnings, long before any money actually arrived. Outside partnerships hid billions in debt off the company's books, so the balance sheet looked healthy while the real numbers grew worse each quarter. When the accounting was finally exposed in the fall of 2001, the stock fell from over $90 to under $1 within weeks. Employees whose retirement plans were frozen during the collapse could not sell their shares even as the price crumbled daily. Thousands lost retirement savings representing a decade or more of paychecks, wiped out in the same weeks that took down the company itself. Executives were later convicted of fraud and conspiracy. The collapse led directly to new federal laws requiring companies to certify their own financial statements under personal legal liability, rules still in force today. 8 days on an island. Sam Bankman-Fried ran a cryptocurrency exchange from the Bahamas that investors had valued at roughly $32 billion, making him briefly one of the wealthiest people in the industry's short history. In November 2022, a single financial news article revealed that his trading firm and his exchange shared the same pool of customer money, a practice known as commingling funds, mixing customer deposits with a company's own trading capital. Customers rushed to pull their holdings before the day was over, and the exchange could not cover the request since the money had already been spent elsewhere. Within 8 days, the company that had sponsored a Super Bowl ad and a Miami arena filed for bankruptcy, and its founder's personal fortune, once estimated near $26 billion, enough to buy that same Super Bowl ad slot several thousand times over, was gone almost as quickly as it appeared. A jury convicted Bankman-Fried on multiple counts of fraud in 2023, and he was sentenced to 25 years in federal prison. The exchange had promised customers their funds were always available on demand. It took 8 days to prove that promise had never been true. Which of these collapses do you remember hearing about when it happened? Tell us in the comments and subscribe for the next one.